Welcome, folks. It is the summertime of 2025. This is the market recap over the last couple quarters. The new tax bill got signed, so we're going to be going through that in the beginning, what implications that means for real estate investors, and a little bit of what it means for the rest of the country. We'll go into what's going on with cap rates, and then in the second half, I'm going to be doing a replay of the market cap recap video that I did about 6 months ago. And I'm going to be starting and stopping at certain points in the video where things have become a little bit more clearer or things might have went the other way. So I think that'll be interesting. If some of you guys are short on time, I would say this first half would be a little bit more pertinent. But anyway, here we go. But I guess from a stock market perspective, when those tariffs went down, it was like this meme here. And then apparently we're right back up to where we are. Now on the right side here, the headers on this diagram, which got cut off, is Shiller's price to earning, which is hovering near historical highs, and CRE price to earnings sitting below its average range, right? For those of you guys aren't familiar, price to earnings ratio is this ratio between price to earnings, which we would think when your price is way too high in comparison to your earnings, that's a time to get the hell out of the stock and sell it. Where right now, the price to earning ratios are pretty much off the charts, as a lot of people have been saying this a long time. Whereas commercial real estate, the price to earning ratio, which is known as the cap rate, is a lot better relative to where it was historically. Some would say it's one of those rare windows, but only if you're playing the long game. You never know what's going to happen in the short term, meaning under 3 to 5 years. All I remember was when I started investing in 2009, I didn't care about PE ratios. I just knew that if you bought a property and you had $600 a month in cash flow, that was real to me at the time. I wish I would have bought more properties back then, pre-2016, even 2020. In a way, it's history repeating itself, right? Like right now in commercial real estate, prices have dropped 20 to 30% off the highs of 2023. And now is the time when there's fear in the streets, right? People look at it who are new and they see blood. But that's, if you look at what Warren Buffett says, what's the quote? When fear is in the streets, that's when you buy. Obviously, the stock market does not obey any normal conventions in terms of gravity or price to earning ratios, but go look it up yourself. But let's get into taxes here. The new big, beautiful bill squeaked through. I'm not going to put in any of my political thoughts because I think that's a waste of time. But let's go through these one by one here. First one, 100% bonus depreciation got extended to 2029. So this is a huge one. So now investors can fully write off qualifying improvements in manufacturing related real estate in year one. So that's 200 billion plus of incentives to build out there. Real estate investors can retroactively amend previous tax returns to unlock immediate paper losses. If you bought something recently, maybe talk to your tax attorney. If you need a referral, let us know. If you need a cost seg referral, let us know. You can go to thewealthelevator.com/vendor. You can go back to past deals, and the general partner can retroactively choose to do a cost segregation. And this is where bonus depreciation has been over the last couple of decades here. This is when Trump got in here last time. He pushed it up to 100%, and then they had the stepwise going 20% down every year. If you bought a property after January 19th, 2025 through December 31st, 2029, that's going to be restored to the 100%. So if you bought a property January 18th, you're screwed. It's only 40%. I don't know why it didn't go to January 1st, but it is what it is. So if you bought a property after January 19th, you could do a cost seg and get 100% bonus depreciation of it. So I do think that this is going to be have a stimulating effect on investments and deals as it did in 2017. Going to the next one, 1031 exchanges. Actually, I don't have it on here, but yeah. So 1031 exchanges survive, no changes there. You can still roll your gains into the next deal without triggering taxes. I think the implication here is it keeps people transacting. Whereas if 1031 exchanges go by the wayside, I think you're going to see a lot of people just hold on to their stuff and there won't be any transactions. That's going to create a situation where people don't put supply in the market. The next one here is R&D deduction restored. This companies can instantly expense domestic R&D. So If you run a small business and last time people did this, some people were, being a little aggressive, buying those little segways. This is a long time ago, right? And deducting those, but just talk to your tax attorney and see what you can deduct there. But I do think this has a stimulating effect on the economy too. A lot of people, at least I know off the top of my head, a couple other business owners I know, they're in this space where they do a lot of R&D. So that's pretty much everything they do is going to be impacted by this. The next one, interest deduction made permanent. Now, there was a time where you couldn't deduct your interest for your home purchases, although, I thought that was always silly because everybody should be calling themselves business owners here and in the business of investing, but that's another here or there. But now they've made it interest deduction. You can deduct that. So that moves the needle a little bit, but every bit counts. I think what also helps is in individual, say, apartment deals or real estate deals, that interest deduction does help a little bit on the P&L. I don't know if it helps when taxes or insurance double on you, but hey, every bit counts. QBI deduction extended. This is at 20% pass through. So think if you make $1 million in income, that could be like 40, 50,000 in tax savings. Not bad. I like the idea of giving money to those who are in business that actually invest it back into the country as a money multiplier there, as opposed to giving out little stimulus packages for people who blow it on gambling apps or tend to just save it and not do anything and just hoard it at home. You don't get that multiplier effect enough. Foreign capital and SALT relief. So the SALT tax came in a little higher than what was thought. This helps people in higher tax states. So this helps people on their personal taxes. Opportunity zones got an extension and a little bit more clarity. And then they also added this new rural component to it. Permanent extension also allows people to get, because this was an entirely new thing. So if you don't know what opportunity zones are, you pretty much get a lot of great tax incentives for going into an opportunity zone, which you can go and Google on the federal website what opportunity zone is. But when you look it up, they're not the best of places. They're usually places I wouldn't necessarily invest in. And this is where I would say don't let the tax tail wag the dog, because a lot of these places just aren't the best places to invest. They could turn around, but it's going to be years. So we've tended to invest in places where it's already in a short term, already in the path of progress or already progressed to a better area. We prefer to get out in a 5-year time horizon where these opportunity zones might be good in 20, 30 years, but that's just not within our timetable. And I do think it's a lot more speculative. Tax estate exemption. Now, this is a big one, I think, for everybody here. You may not be to $5 million, $10 million net worth. If most of us pass away in our 80s or 90s, it is very plausible to get up to this number. Previously, what was going to happen, it was going to go down to 5 million, which I think would have impacted everybody here, all the accredited investors, where any amount higher than that certain threshold would have gotten taxed, which is unfair if you've worked so hard to get it. Now, people who were sophisticated were creating their irrevocable trust to get money out of their estate in preparation for thinking that this might go down. But for people who haven't set that up because they procrastinate to the last second, it looks like you have another 4 or 8 years to do this again. This number dances up and down. So if people remember when George Steinbrenner died, that particular year, for some strange reason, there was not a cap on this. So he was able to pass away his, I don't even know how much, my guess is like $300 million estate tax-free. But yeah, if your net worth is over 5 mil, you probably should be in our family office, Ohana Group. And you should be talking about irrevocable trusts, getting money out of your estate, and these types of discussions with this. So those are the big ones for taxes that involve a lot of us. I think the big one here is the bonus depreciation, where this thing got put right back up to 100%. So that's huge. These are the ones that are more important to people out there and what you'll probably read in Wall Street Journal or the news. I'll go through it, add a little commentary on each of them, but I don't think they really matter to us. But first one here, all these tax cuts are made permanent. Haha. But just kidding. I think it's funny how they say that word, but it's just until the next administration changes it. The clean energy tax credits rolled back. So less incentive to invest in solar or green retrofits. Underwriting may shift slightly on those asset classes. Again, this is something I don't know how it's going to really play out, but I don't really see it changing too much. Some would say that it's like, Trump's way of sticking it to Elon or whatnot. I don't think they really think about it on that matter, nor do I think that those individual guys have that much direct input on that. If I'm reading between the lines, I do think that there's going to be a shift back to common sense. Oh, did I say that? I'm not allowed to say that. Yeah, I think they're coming back to oil, right? Oil and gas. And so it's something that we've been eyeing a little bit on that front. I guess that the narrative there is it costs so much money to do these clean energy things, as much as they look good on at a dinner party about how you have your Tesla and you have all these solar panels. They're just too freaking expensive. And you got to burn oil and fossil fuels anyway. And especially with this Russia thing going on and all that stuff in the Middle East that I don't know all the details on personally. I know some people are very interested in that world, but all I know is it all has to do with oil at the end of the day. So less foreign reliance on oil. To me, if I read the tea leaves, are pointing towards it'd be smarter for America to get off foreign reliance on oil, as it has, right? And that's why there's great tax incentives in that world. If people are interested in that, I would Google IDC credits, which are intangible drilling costs. The cool thing about intangible drilling costs is that you don't need real estate professional status. There's a little bit of a carve out for those people with high W-2 incomes to use those IDCs to lower their taxable load. So the next one, no tax on tips. I don't think anybody here works tips jobs. I'm just interested in how this kind of gets implemented. I think it's on $25,000 of tips, but what's to stop anybody from just saying, hey, I'll invoice you for this for 10 grand, but hey, give me the rest in tips, 25 grand. I guess you have to always report appropriately, but what's to stop people from doing this? Is this going to be just a dummy deduction, where what I mean by dummy is like everybody should take the damn thing, right? Just check the box. Yeah, 25,000 on tips. It's just how you structure your invoicing as a business owner. But I don't really care, and I don't think it really moves the needle. But I think it's one of those things thrown in there just so that people fixate on it. Again, this is, and I took this from a very main media source, so that's what they focus on in the article. Same thing like car loan interest deduction for like Fords and Chevys. I don't really know what the impact of that. Seems a little silly to me that it gets thrown in there. But hey, if it distracts people from the fact that we are all getting 100% bonus depreciation and R&D and 1031 exchanges are still here, then I guess maybe that's what politics is all about. I think it's a little lame. But next one, 6,000 senior deduction. And this is a small benefit for retired investors maybe out there. Marginally improves after tax income from investments. And if you want my take, once you become a retiree, you really fixate on small things like this. And this is why, at least the lesson learned that I see from investors, even investors in our group, is you really got to just blast past 4 to 5 million when you can. If not, you're just going to be pinching pennies or rejoicing over $6,000 of deductions over a year. If you don't want to be that person, then you got to get after it in the years that you're actually producing high amounts of income. Next on Medicaid work requirements. I think this is something that a lot of people are upset about. It seems, what did they say? I don't know why they always fixate on Trump, like he's the guy who made it, but Senate, House, executive branch, they got rid of this and it hurts other people. Some say that it only puts scrutiny on those people who really don't deserve it, such as people who aren't looking for actively for jobs. I don't know. I'm not going to waste my bandwidth on it thinking about it. I actually think that in the long run, it doesn't really pertain to me too much. So I tend to not focus on things I don't have control over. And there's other things in here that are a lot more impactful to us out there, such as the big boost in defense and homeland security. As I've said before, I cheer for Japan in the World Baseball Classic that I think is going to be this next year. But when the nukes start flying, I know who I cheer for. USA, USA, USA. And then I think the thing that a lot of people are up in arms against is this thing added $3 trillion to the deficit, and it could pressure interest rates longer. We've been in this monetary policy since I think the 70s or 80s when we went off the gold standard. This stuff is here to stay. I do believe in ITR economics thesis that after 2030, 2032, you're going to have a bigger correction at that point. So personally, what I'm doing is I'm trying to make hay before that, get my nuts stuffed in my tree and be ready for that. They're saying the second half of 2025, 2026 is going to be a big thing for industries. We've already seen the stock market correct. I think a lot of people are still waiting on what the tariffs are. We will move on to what's been happening with apartment cap rates, or as we all know, cap rates is pretty much what are the properties worth today. So if you want market values, this is what market values have been doing. Normally what you have is you have market corrections, right? And 2-3 years removed, we now know that the dust has settled, that the market correction was somewhere around that late 2023, early 2024 time here. That's what this little hump right here signifies. And the best time to buy or the best time to be exiting deals was the end of 2021. And previously, the last correction was, as we all know, 2008 to 2009. So in that time period, you had the cap rates coming down, which means that prices are steadily improving. So if you go from 7% to about 5.5%, that's 2.5%. That was over 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 years. That was a decrease of about 0.2 of a point every year. So we had a nice trade wind behind our backs of 0.2 of a percent. Now, most underwriting standards say that in a good market, you underwrite for 0.1 of a point, which is a little bit lighter of a decrease. But here we had a 0.2. So I say that because people ask like, all right, so the market just got absolutely killed from 2021 to 2024. You had a cap rate correction of at least 1, maybe even 1.5. When are we going to get back to here or even here? Based on historical, the last market recovery came at 0.2 of a percent every year. So if you wanted to get back to just under 5, maybe not in the mid 4s, you do the math, right? Like 0.2 times 1, 2, 3, maybe 4 years, 5 years. If you want to go more conservative, again, what I said is traditional underwriting standards say you go at 0.1 of a percent every year. So if we're sitting at, let's just call this 5.8, that's 8 years to get to the 5%. And this is all asset classes, whole bunch of markets out there, right? So you could have a range of plus or minus 2 on here. For our purposes of discussion, this is a pretty textbook correction and recovery here. I would say this recovery is a little bit longer than most. Most textbooks will say your recovery will be about 6 to 9 years. But this one was obviously a lot longer. I think the big thing, looking back, this is all, everybody's a Monday morning quarterback here, but they said that we should have had that correction a few years earlier during the pandemic. But the pandemic, what happened is the world shut down and then the government just printed trillions of dollars, right? That's what kept it going a little bit longer and maybe what made it worse in 2023, 2024. I don't think a lot of people understand this, but it is pretty simple. And that's the unfortunate part. Things go down a hell of a lot quicker than when things are ever improving, as you can see here. As far as interest rates go, some will say that there's like a 70% correlation between interest rates and what cap rates do. So the Fed dropped rates ever so slightly off the peak of a year ago when it got up to 5.5. Now we're at 4.5. There is an anticipation of a couple of rate cuts later this year, but Jerome Powell has emphasized, and I'll use his words, the central bank is well positioned to wait. He's citing lingering uncertainty and no immediate signs of economic weakness. So he's right there, right? Based off ITR economics, the economy is doing pretty well. Now, you obviously may disagree if you're in tech and AI is displacing you, but generally speaking, if you look at production measures and industries, they're doing pretty damn well. Unemployment hasn't really spiked too much. And those are the two big data inputs that Powell will cite. And he acknowledges that inflation expectations have increased due to the tariffs this past quarter. But nobody knows what their full impact is. Everybody's saying, pal, you should like drop the rates, right? The economy is fine. You're killing us on the commercial real estate end. But keeping interest rates high is similar to holding dry powder. And dry powder is what you use to get you out of a stuck economy. And that was where we're lucky during the pandemic that they had raised rates up to what, 2.5 we got up to. And just by happen, but we're just lucky, I think, that when the pandemic happened, they stimulated the economy and dropped it down to zero. Yeah. But we don't know what's going to happen. So in a way, we have a boost card, or if you guys play Mario Kart, since most of us investors are people born after 1970, it's like having the mushroom that can boost you forward in your back pocket. So Powell chooses to play this game with the mushroom, which is smart, right? Like you never know what's going to happen. And Trump's obviously pressuring him to use that mushroom and drop rates. But what if there's like an escalation in the war and then you gave up your mushroom or dry powder for you baby boomers out there? Use that analogy. So discussion in why supply and demand is obviously a big impact on what is happening with cap rates out there, along with interest rates. In a particular market, if you have a lot of new inventory being brought online because they were started building it a year or two ago, then your rents are going to come down, right? Because you're going to have less stuff out there on the market. So the problem with getting these developments off the ground right now, as we are in this world, like we've got some developments that are absolutely just stuck in the mud because you can't really go to construction when your interest rates are like 13%. Or originally the deal was underwritten to sustain maybe 9%, where when you started the deal, interest rates were like 0%. It was the Fed rate at that point. There's not a lot of new inventory coming down the pipeline in the next few years. But right now, everybody started to build up until 2023. Why? Because that's when interest rates started to jack up and their construction loans started to be a lot higher and to unsustainable levels. Right now, you're still seeing that pre-2023 apartment load come through to market because it usually takes a year or two for these apartments after they start construction to be born. That's where you're seeing a lot of this new supply coming online. So you're seeing the bottom left here, multifamily completions outpaced starts by 262 units in the last 12 months. That's where you're seeing the spike here, and then you're seeing it drop off a cliff, right? Like I said, different chart, seen in a little bit different way. This is putting the teal line is your supply of inventory. That's really high right now. That's why rents are stagnant. The long-term demand looks really good, right? People need a place to live, especially apartments, the lower middle class. But the other component of this is the supply-demand differential here. Other stats, 138,000 units absorbed into quarter one, 2025, which is the highest in the last 30 years. People might be saying like, wow, that's a lot of freaking units, right? But the other side of that is, yeah, that's a lot of freaking units that just got absorbed, right? That's the demand, right? The demand is there, but there's just a ton of supply right now. We just highlighted Houston here because we got some assets out there. But I think from here on out, and don't know if it's the end of the year, don't know if it's the beginning of next, but supply is falling and demand is rising. New apartment deliveries dropped substantially in 2021, 2005. It dovetails this image here. This is where if you can hold out over the next year or two, the new supply is going to stop and then rents are going to come right back up. And I do think that this is going to be very inflationary to the statistics that Jerome Powell looks at all day. It is very known that the apartment rents out there, or what people pay for housing, is a huge part of CPI, huge part of it. Some would argue right now, inflation is a lot less than what it is reported because there's a lagging factor, because when we bring in tenants, there's a year delay there, right? People sign annual leases. So there's about a year lag. So I do think that there's the tariffs inflationary impact, and then there's also the deflationary pressures of rents going down, which we know over the last 1 to 2 years. The idea is apartment rents are coming back up. If you look, we know what's happening with the supply, and we know that demand is strong out there. A lot of these markets have just absorbed the highest amount in the last 30 years. Some other highlights here. You haven't seen any multifamily deals from us these last couple quarters because the deals just, they're not penciling. And what I mean by penciling is when you take the P&Ls and the rent rolls, you put into the analyzer, because the operating expenses are so much higher. And I think a lot of you guys are seeing this too, right? With your homes, the taxes, and insurance are just, wow, it eats up pretty much all free cash flow. So one thing I wanted to add in there, insurance, we've been seeing some of our insurance costs come down slightly off the peaks, but this is just on rare occasion. So that might be some relief ahead the second half of this year. The other big thing is the debt service, right? With interest rates way, way higher than what it was a few years ago, the deals just don't work, which is why the prices have come down so drastically. Here, Fundrise says 35% off the peaks in 2023, which is worse than the 2008 Great Recession. And we're talking commercial real estate here. We're not talking about residential real estate here, where I do think that residential real estate hasn't gone through its cycle yet for different dynamics, right? Because people buy properties in commercial real estate off a 30-year amortization, where commercial real estate is anywhere from 1 year to 10 years typically. But across the country, you're seeing 20 to 30% discounts of what it was off the peaks. Or for you geeks out there like me, cap rates have gone up 1.5% to maybe 2%, depending on which market. But that's where it's hard for these deals to pencil, and we've been really selective. The only deal that we did really was a deal where we had an assumable loan at 3.8%. So it was like you had a deal that was today that was discounted, but a loan package from 2020. It was just a dream scenario, which doesn't come around very often. But we're continuing to look. We always look. For those of you guys who are interested in seeing what we see, I did a video on a little 100 unit that we went through some of the underwriting on and disqualified. We're not just sitting on our butts here, guys. We're looking at stuff. If you guys see any deals out there, let us know. We'll underwrite it. We have the review service right now, the wealthelevator.com/review, if you want to take a look at that. But there have been obviously opportunities outside of the traditional multifamily value add sector. That's for sure. I do think long-term apartments, workforce housing for the lower middle class, I do think that the long-term fundamentals work, which we've talked a lot about. I'll just take the words from Berkadia's 2025 multifamily outlook. New construction is slowing after a multi-year surge, especially in the Sunbelt and Mid and Mountain West. Strong demand with home ownership affordability at 40-year lows, right? What's the alternative for these guys? What are they going to do? Buy a house, and now instead of paying $2,000 a month, it's $4,000 because of the taxes, insurance, and interest rates higher. Rental demand is stronger because of that. And then also, right now, a lot of the institutions are still on the sidelines and they're re-entering, right? But that's what creates the situation where you talk about inflation. Inflation is really good for apartment owners or people who own assets. But also, when you have that inflation comboed with the larger institutions coming in, that's really where you look at like a genius, I think. But right now is that window of opportunity because it's that temporary pause in the competition creates a chance to invest before the activity bounces. But unfortunately, most people will find us when they start to learn that, oh, real estate's a good place to invest. They'll probably come around in 2029. They'll be that guy that you'll see at a retreat that just heard about commercial real estate. And for all they know, they could be the guy who comes on the craps table after a good run. The craps comes out after that guy comes out in 2029. I will point out from using an example of lithium, market cycles are inevitable, whether it's stocks, real estate, commodities like lithium, prices fall and prices rise. Timing is part of things. So what this is like a chart of the different years going back to 2014. And you look at lithium, and you see how it's on the top, on the bottom, on the top, on the bottom. Lithium is very bipolar here. But I think that the thing is novice investors look at what has been doing well and they pile on there, which lithium teaches us that is the complete strategy if you want to not be a good investor. Now, real estate, overall stock market doesn't act as rapid like that. But this illustrates the point that jumping in at the peak often leads to painful lessons. You need to identify what is value to you, right? Like I think when commercial real estate, especially after going down 20%, or in places like Phoenix going down even 30 to 40%, I think that the value is there. But it is oftentimes when people are very hesitant and there's fear in the streets. But this is where savvy investors look where others hesitate. And they ask the question, hey, who cares what's doing really well? Tesla, I don't know if Tesla's doing well. I don't really pay attention. Or NVIDIA. What has been beat up in the last 6 months to 2 years? That's the question that sophisticated investors ask. But it takes some cojones to take action off of that for sure. But short term here, maybe in the next couple of months, is all in the rearview mirror. But I think we're starting to see the light at the end of the tunnel on this. But the tax bill got signed. Tariffs seem to be resolving. I think overall, America, Trump, whoever we want to call it, is going to get a win through this at the end of the day. Like a lot of people are like this guy talking to his girlfriend here saying, yeah, I don't know what we're doing. I'm just part of the situation here. I'm just going to not do anything. But I think that this is the wrong thing to do as an investor. This is, again, the time when you need to be finding those hidden gems, or as Berkadia says, the window of opportunity is now. This is what most people will do out there. This construction worker guy, they're just trading time for money, and they are just waiting to what's going to happen with the tariffs when that all resolves. One first thing before we get into the last report, this is a source from Tiger 21. So these are very high net worth investors. I think you need to have a net of investable assets of 20 million to get into this group. Our group, the Family Office Ohana Mastermind, I would say would be the lead up to a group like this. A lot of these Tiger 21 guys are business owners or second or third generation multimillionaire families, where I think a lot of people in our family office group are first generation. A third of them are business owners, right? But not yet to this scale, right? But I think it's important to look at the people who are 20 million, $100 million net worth on the family office scale. What does their asset allocation mix look like? What are they investing in? And look, I'm not a certified financial planner. I'm not allowed to talk or give advice on asset allocations. So I'm not. I'll put that out there. I guess if I was, I would have to charge you for it because that's what they do. But this is looking into what ultra high net worth investors are investing in. They're in the blue, and the yellow one is what the amateurs are doing, the retail investors. Just take a look at this and see where you're at. Personally, I take a barbell strategy where I have a heck of a lot in commercial real estate, which the way we do it is a hybrid between private equity and real assets, and my other smaller portion in life insurance. So I would say that's more on the cash and fixed income category. So I've probably got like 80, 90% here, maybe 10% here is where I'm at. It's a barbell because it's really heavy on the ends, but still balanced. I don't have any public equities personally, but this is what the ultra high net worth do. And this is what Amateur Hour does out there. What I would also recommend is if you don't know about things like private credit or hedge funds, right? This is like investing on the debt side of a deal, whereas the opposite is the equity side of a deal. Maybe learn about it. Give us a call. We can walk you through this. Shoot us an email time when that works for you. But I think if anything, awareness is the first step, right? Most retail investors only know about public equities through their 401k. Most of you guys here are totally aware of private equity, investing in businesses, and then real estate value add strategies. So that's where these two are at. I would say be aware of these different asset categories here, which private credit is a big one for the ultra high net worths. Here's what we're going to do. I'm going to replay this market recap. It's about 50 minutes, but I'm going to start and stop it at certain points where things have changed. And to do that, make it a little bit less confusing, I'm going to wear this black hat. So you know that the black hat person is the person who's a little bit more wiser by 6 months. And we are going to go through this. Oftentimes you don't go back and reflect on maybe what some predictions or things that we're stressed out about, worried about 6 months ago, and how things developed later on. Additionally, I got to be honest, I'm a little lazy here because we just had a kid this past month and things haven't really moved too much in terms of the economy. everybody thought that there'd be a lot more rate cuts by now and a lot more lowering of the cap rates, improving on the market. But it just hasn't happened yet. I think it's because of the uncertainty with the tariffs. And once we get that behind, it's off to the races again. But let's go ahead and do this. Well, welcome, folks. This is the 2025 preview. My hair is super long, which means I'm trying to save some money, not getting a haircut before the holidays. Today, interest rates have come down maybe about 10-15% off the peaks that were previously set was 5.5%. We had an election. We had a couple rate cuts, half a point and a quarter point, which puts us still very high. Just updated this chart. 40-year high, quickest time in history, which is the big thing. And this put shockwaves through commercial real estate, because in commercial real estate, a lot of times what you have is bridge debt being used. And bridge debt is loosely defined as 3 to 5 year terms or less, meaning that if you have a big correction, which boy, did we have a big correction. How did it compare with the Great Recession in 2008? From there, we saw commercial real estate go down 29% from the peak. And this time, article from JLL, from this article right here, if you want to take a look at it, Fed saying 35% down from the prior peak. So normally, or at least what I'm taught, normal corrections are about 10 to 15%. Obviously, this was a doozy in comparison to this. And the reason being, inflation just skyrocketed because the government created a whole bunch of money to keep us afloat during that pandemic. Yep, you remember that pandemic, but that's the quick recap on where we came from over the last 4 years. And over the last couple of years, complete bloodbath, if you ask me. We've been heavily impacted, more so the deals purchased at the peaks, which we all know now was 21 to 23. But it's difficult, and if that's the vintage and projects you're in, but unfortunately, it's a kind of a new day, and I'll interject there. There's been some recovery of the market, and on some projects that we bought 2020. So this is not at the peak of the market, right? But it's still, all assets are impacted by this. Probably came, maybe 10% off the peaks that it did ago, or maybe closer to 20% too. But some of these deals, like we bought in 2020, we've already value add all the units, but it's kind of a bittersweet exit because normally we'd be probably selling it for millions and millions of dollars more, 20% more. But we're in this tough spot where we're going to sell for a gain and profit. But again, it's bittersweet because you're selling it in a depressed market. And some would say it's like, well, why don't you just hold on, right? Wait for the market to recover. So, well, we could. And like I said earlier, a fair assumption would be assuming that the cap rates come down 0.1% every year, or 0.2% to be more aggressive. And we wait it out 3 years more. So call it 0.6%. All right. So I get my property, I plug it into the formula, I get my property to sell at $4 million more at that point. Is it worth it? If that just means I get an extra 10% for holding out. But then my argument is, I think we should just sell, take our winnings. And because if you can enter new deals today that have somewhat of a distress component or of a seal of a deal today, like a development today that they're building today, you should enter in that deal because you're going to make a higher return, right? At the end of the day, in these deals that have been entered, like in 2020, the value add, the construction has already been completed. Like the juice has been squeezed. So the right thing to do, thinking from your head, not your heart, is to sell those assets, take the profit, and redeploy into newer stuff, as opposed to just, turning a 5-year deal into an 8-year deal. And yeah, you make more, but I think at the end of the day, if you were deploy the money, and I have my own money in here. At the end of the day, I would rather take that money, even though it's a lot less than what I thought it was going to be, and put it into new stuff that's coming out today. This is what we're seeing as a different viewpoint of pricing. In a way, you see that kind of run up in 2020 to 2022, and then the steep decline that happened after. So right now, some perspectives on the market. A lot of operators and institutional groups. You're seeing the big players jump in at this point. KKR spends $2.1 billion. You're seeing the big hedge funds out there grabbing commercial real estate. Not so much office. We'll get into that a little bit later. But this excitement around buying and I think we've been getting a lot of questions from our investors. There are a lot of properties that were bought at the peak, and whether you run the assets good or not, the price has come down. And even if you use longer term debt, 4, 5, 6 years, or maybe you own the property since 2018, 2017. And if you're doing the math right in my head, if you had a 6-year term, your note is coming due and your property may be worth pretty much what you bought it for just because the market came down so heavily. So you're having a lot of these situations just because of the loans being used, which is pretty consistent in the commercial real estate world. Now, what I wanted to make the distinction of is when properties are into the state, what you'll start to have happen is the operational funds are going to get dried up. And at that point, your asset still operating, still very well, may have good occupancy, but it starts to become a little smelly, not quite rotten yet, but you start to have owners may not fix things, may not be up and up on the tenant profile being brought in. I think from our perspective, though, I don't really want to go into a distress asset or one of these so-called good deals per se, because I can just buy very clean assets that don't really have any smell or decay to it because the entire market has dropped so heavily. Like you're buying things at such an amazing price. In particular, you're picking up properties that are brand new build that you would buy a few years ago that were like 1980s property, something like 40 years newer. You're buying it for the same price today. So the way I look at it is, first of all, you don't need to go in with the bridge debt type of business plan. You can just do it a long buy and hold. And because you're buying it at such as a good price, or what we call it in the industry, buying it at a good basis, such as today, you're going to make money, assuming you implement your business plan and the market stays pretty neutral. At that point, why go after these more hairier assets? Now, I get it. If people want to do that, more power to them. And I think they can make a lot of money doing that. It's just, I'm looking at it as if you can make good returns, why take on the extra risks? If anything, right now is that kind of that time where the prices have come down to a point where things just lights up the spreadsheet in a way. But from a market perspective, and we'll get a little bit more into detail on this, you're having a lot of new supply hitting the market, which is making things a little bit more difficult for the lower end properties, the Class C assets, which is why you're seeing us target a little bit more nicer properties, more Class A. And then, like I said, the major players are bringing competition back to the market. It's your newer investors, your retail investors that are ones that are saying, I need to wait to see who wins the election. And I need to get confirmation. I need to see 3 or 4 good years in a row, and I'll be in 2028. Trust me. We all inherently know that's the wrong thing to do, but that's ultimately the natural tendency for retail investors and the complete opposite of institutional purchasers like KKR. A lot of this is dictated by interest rates, which impact the cap rates. And I've always been looking for a certain number of correlation percentage. It took me a long time, but I finally was able to track down somebody who stuck their neck out there. And whether it's right or wrong, I actually think it's correct. If you take it as a general rule that 70% correlation between the cap rates and the interest rates, with the remaining 30% driven by market sentiment and other factors, essentially meaning that commercial real estate is heavily impacted by what the interest rates. We had a question that somebody put in here. They're talking about residential real estate. So residential real estate is very different than commercial real estate. We've traditionally stayed away from residential real estate because of the risk factors, working with smaller operators, and how much it's really not correlated with the performance of the asset in terms of the operating budget, where at the end of the day, residential real estate is dictated off of the comparable sales. What we've seen as interest rates turn up, you're seeing a lot of people stuck in their mortgages. People who have houses who locked in aren't going anywhere. So they're prisoners in their own houses. You can say that the buyers, the new people trying to get in, are taken out of the market at this point. But because of the low supply in residential real estate, you're seeing the prices stay stabilized. But the difference with commercial real estate and what's created this great opportunity for new investors to now come into the market, as you're seeing the big players do, is that because you have a quicker turnaround, you don't have 30-year mortgages in commercial real estate. Sure, they're amortized in 30 years, but you have these loans reset quicker. Whereas typical ranges are from anywhere from a year to 12 years is the longest that we normally see or we have in our portfolio. You could get a 15-year mortgage, but it's typically you pay more for a rate, right? So there's always a trade-off between the term and your fee structures that you get assessed by the loan. There was a white paper in 2016 put together by TIAA Global Real Assets. Might be a little bit outdated. They said 70% correlation between cap rates and interest rates. It's not 100%, but it's more than 50%. But I think what we've seen over the last couple of years definitely impacted pricing, right? Again, interest rates skyrocketed from pretty much 0 to 5.5, 40-year high, and commercial real estate prices came down, 20, 30% off the peaks. Some would even say more than that. So where does this put us now as individual operators here? What's my viewpoint? When we look at new deals and we're modeling the exit cap rates, it's a head scratcher because right now the cap rates are so high. Meaning if you're new to this, what I would highly suggest is go to the numbers section of the syndication e-course and take 15, 20 minutes and read through the reversion cap rate discussion. But when your exit cap rate, or other known as the reversion cap rate, is incredibly important. And it's one of the biggest ways that operators fudge their numbers to make a deal pencil out or project out better than is. Generally accepted in the industry that when you underwrite, you want to try and be a little bit more conservative. It's something that we've always followed ourselves. And we want to model an exit cap rate that takes into account a weaker market. What we've seen is, like, over the last couple of years, cap rates are very high, meaning that the higher the cap rate in the prevailing market, that means the less money you get. And thus, as you can see, the prices are down. But we've seen in some markets possible compressing of 75 basis points off of their peak. So that means coming down, meaning the prices are getting stronger. Now, it depends on the market, it depends on the asset class, of course. But these are the signs that you're starting to see that bottom develop. Maybe it was 6 months ago. Maybe it was a year ago, right? If you're somebody who's saying, I'm just going to wait until I get confirmation, you're not going to hear about it in the news until a year or two later. The Wall Street Journal, you're always going to, I'll pause that right here. I do think that we've seen some markets correct and start to head the other way. The only data points I have on this is we've had a couple appraisals show significantly higher than what it was 6 months ago or a year ago. Again, like the graphic that I showed earlier in the first half of the presentation is showing a prediction. And I do think it is validated here. And what I'm saying here 6 months ago is, I think it's true where it's heading. And be it like 6 months, a year behind in that thing. Ultimately, it's the brokers that have their finger on the pulse where the cap rates are trading for at that moment. But what we do know is a confirmation of the top of the interest rate cycle. I think it's safe to say that at this point, that we saw the top of the interest rates as we've seen 0.5 point and then another 1/4 point very recently. I'm not going to say with Trump now going to be the next president. I have an entire slide on that coming up in a little bit. Obviously, I think his stance, whether he gets his way or not, is that he brings these rates down quicker.
Newsflash, he's president now.
At this point, the best estimates, what we do know is the top has been confirmed. And the general consensus are things are going to start to come down slowly. And if you're seeing these prices are correlated by 70%, one would assume that these prices are going to get stronger from here on out. Here's Green Street. They've put into this image here that they're saying that in Q4 of 2023, they predicted that was the bottoming out, as they're starting to see that reversal over the next 6 months into June, which is in our rearview mirror. I don't really want to put things out prematurely, but if you're somebody who's, let me see another year or two from today, these are the signs that we saw 6 months ago to this date. And as we all know, it's 2010 to 2012. If you were around, I think all of us were living at that time. But did you have 100 grand, $1 million in the game? Perhaps you were just investing in the stock market stuff, so you're insulated here. And that one's a head scratcher, right? That one's kind of like at all times highs. I have no idea why. I'm just going to focus on what I do. But if you're an investor who sees things as right now that is hot, that's overheated, and commercial real estate is down, of course, we don't only do commercial real estate. We also are now in buying businesses and private equity, which have their own market cycle. Everything has its own market cycles. And the idea that I go off of is you try to diversify. I was heavily in commercial real estate, so a lot of my lessons are made in blood there. This is the run up that we saw from, like I said, 2010 to 2012. That was a great time to be involved in commercial real estate. What we're showing here is the Arbor small market multifamily price, which is more of, I think, the kind of apartments that will target the Class B type of assets, the non-institutional type of assets. The boring apartments, this kind of mimics that more closely. But this is the pricing index, and you're seeing that big push up after 2020 when inflation just rose. And if you're concerned about inflation, you buy assets. I don't care if it's real estate, but you buy assets because assets typically go up with inflation, right? The worst thing to do in an inflationary environment is to hold on to currency, because that's the thing that doesn't really go up in value, gets devalued in those times. Like I said, the interest rates went up mid 2022, and that became, there's your 70% correlation right there. And now as things are going back up in terms of, you're seeing a little bit tick up in prices, and because of that interest rates come down a little bit, I still say there is still a delay, and that's the uncertainty here. We know that interest rates are going to come down, but to see the true impacts of a 75% basis points of interest rates, I personally don't think you're going to see that for at least another 6 months. Might even be a couple of years for all we know. And that's that delay factor that's not really accounted for. But we know where the momentum is heading. This is a big cruise ship. The ship is not positioned and turned the right way, but the motors are moving in that direction. What you're seeing, if you draw a straight line here, you're right back at, if you went and took a nap in late 2020, that's where the prices are at today, in a way. This is from ITR Economics. Supposedly, these guys predicted the 2008 recession. There's a lot of other guys out there that have YouTube channels that predicted the last 8 out of the last 2 recessions, as we all jokingly say. They're always predicting the end of the world, and then they delete this video, that video, so that their batting average is a little bit better. A lot of people subscribe to doom and gloom, but very little people, I think, are willing to stick a flag in the sand and actually put some money where their mouth is. And that's where I'm at. Yeah, I don't know if it's a bottom. I think the way I look at it is the prices look good. I think if things pencil, then just take the dollar cost average approach. But as far as ITR Economics are saying, housing has hit this hard landing and is on the up. And if you're believing in the soft landing for some of these other sectors, is what you're hearing, this is what's coming out of it into the next year. What we do know, and this is in hindsight because this did happen, is your financial sector, which is those guys went through the hard landing portion and now they're coming back up. And housing and financial sector, because again, housing is 70% correlated with interest rates. That's what goes through the hard landing there. And this is the tough part, right? Like, this information that I'm telling you is not really useful for the next 5 years. If you're seeing how this is lining up, the next 5 years are perceptively good times. But what we need to keep in our mind, and where I try to just stay a student of the game here, is the next time interest rates get cranked up, things get shaky in the economy, it's the financial and the housing sector that are going to lead the charge into the hard landing first, and then the rest of the sectors follow. And the way I think about it in my head, it makes a lot of sense, right? If you can't borrow money, liquidity dries up. It's going to take a while for the business owner to be like, oh, I'm going to cut some jobs here. I'm going to buy less marketing, hold less inventory. And then that kind of gums up the supply chain and backs up things. And you don't see that play out. And that's what you're seeing here, right? Financial and housing sector went to the hard landing. Everybody else, all the kind of the followers, the other industries, I'm not going to pat Jerome Powell on the back because I'm upset at the guy. Not him and I aren't friends, and I don't blame him either. His job is to engineer a soft landing, and inflation was out of control. So he pulled the only lever that he had, which is to increase the interest rate. But it's all cause and effect at the end of the day. And so let's get into some specific trends in commercial real estate. This thing, taking that same image from ITR back in May 2025 here and June 2025. The last one that was displayed, I believe, was from 2020, late 2024. So if you flip back and forth in this video, you can kind of see some of the differences. There was a little bit of a change from just 2025 to June 2025 there. Obviously, you can see how a lot of these have kind of progressed if a snake eats a rat, it kind of passes through its tummy, right? That's what's kind of happening here. So everything is kind of moving throughout. So wholesale trade production, no significant shift. Financial slightly shifted further down the curve. So something that new came up is this single housing unit. So ITR economics was like, yeah, we can't just call like commercial real estate a residential real estate. Like in 2008, everything was impacted. But in this case, if you go back to that image we showed a couple of times, there was a detachment to commercial real estate and residential real estate. And again, because residential real estate is on a 30-year time horizon, amortization schedule, and commercial real estate is a lot more, it feels the bumps a little bit more, which is good and bad. So they detached that and they put single housing unit here, which they're predicting that single family homes, residential stuff is going to be going down, right? If is what they're saying, because they put it here. And their quote is we've switched to using single units in to reduce confusion caused by the divergence between single and multi-unit trends. So that's why they created this out here. Financial and commercial real estate, again, is kind of on the upslope again here too. But this is generally where your economy is at, right? Like this is what we're saying earlier, how the economy is doing well. Again, sorry if you work for a tech company and AI is displacing you. That's not a macroeconomic thing. That's somewhat micro. Sorry again, but that's what that is. But you're seeing what's been happening recently. All right, we'll get back to the older report. Real estate. First one, observation is positive. Commercial real estate impact with increased activity expected in 2025, but continued with interest rate volatility. This impacts all sectors. So meaning multifamily, office, self-storage. That's what it means by all. But yeah, like I think that the reaction that people need to keep in mind is diversifying across markets and timing of transactions, or when you enter your entry points, and avoid reliance on market timing alone. So that means two things. That means number one, you don't want to call the bottom and be too early, nor do you want to be too damn late, right? Waiting till next year or the year after. And I think this is where I take this to heart and be like, look, I don't know if this is the bottom. I really don't know. But I look at things like apartments or like the businesses that we buy, and is there a long-term need for this? Are the market fundamentals right on this? And if the numbers make sense, always be dollar cost average. Investing is my idea. From 2010 to 2023, it was a nice bull run. Nobody could have ever known that 2023 was that peak of the market. You would have never known. If you knew, you're lying, or you should be a gazillionaire at this point. So at least where I'm at, being wrong myself. With that humble mindset in mind, I say, you don't know when a correction is going to be. You just have to assume that it will happen at any point between somewhere around 5 to apparently 12 years. And with that assumption, what do you do then? Then you just like I said, you just dollar cost average and you invest. So one trend that I wanted to dig into is in 2020 to 2022, when interest rates were good, a lot of people, ourselves included, as developers, because we do develop, like gangbusters. Because with the relatively lower interest rates at that time and the extremely good fundamentals, especially going into 2021, 2022, where rents were skyrocketing, it made a lot of deals like really light up green and made a lot of sense. So a lot of people rode this wave and started to build projects. Think of it like in 2020, everybody was stuck at home. Sure, I guess they were fearful for their lives for the pandemic and everything. If everybody was stuck at home for a little bit, you would think that 9 months later, you would have a lot of COVID babies. I think that's what happened. I could be wrong. But essentially, that's what happened for developments. In 2020 to early 2023, there was a very conducive environment to have developments or building babies. And building babies don't take 9 months to build. They take more like 2 to 3 years to come out of the womb. So right now, you're seeing that come out a huge supply and really impact the market, where you're having a huge amount of supply hit the market. And this is where you're seeing charts from CoStar say that this is on a quarterly basis, but you're seeing the amount of apartment units started. This is where the point of inception, if you want to think about it, or when you stick the shovel in the ground, and then 2 years later, in theory, is when those babies will be born. The peak there, beginning of 2022 through 2020, and you add 2 years onto that, then that's 2024 to 2025. And that's a reason why almost double the amount of units are coming online than normal. New units are Class A units, the newer stuff. So what that does, it increases the supply, and that supply will get absorbed. But what it's doing, it's displacing the Class C tenants, because what's happening is if you're a tenant, you're like, wow, that Class A apartment, maybe I can stretch my budget. And the tenants aren't the smartest people in the world. These new apartments, they give a month or two of 3-month rent. And the tenants don't really understand it's just like a quick time discount, and they probably overextend themselves. They may be legitimately able to afford $1,000 a month, but they may stretch to $1,400 with that free couple months rent. What that is doing is displacing a lot of the Class B and C renters. And the lower end of the threshold, you're seeing a little bit lower occupancy in those sectors. Now, I think this is a trend that may continue out for another 2 to 3 years from now. But long term, this is going to dissipate when the new supply babies are all done being born. What we do know is the data's in on this, is that new starts coming online, especially getting into late 2024, are severely down from even normal. If we can stick a shovel in the ground 2025 and it being built in 2027, you're having a good amount of all this supply getting absorbed, and there's going to be a dry spell happening. So update, middle of 2025, the starts for new multifamily projects in Q1 and Q2 are at historic lows, down 38% from the peaks of 2022. And obviously this suggests a supply gap beginning around mid 2026 into 2027, when if you're an apartment owner, you should see the competition drop off a cliff at that point, and ideally rents increase from there. Obviously, all markets are a little bit different. I think like places like Phoenix got overbuilt, especially. So it might be the tail end of that 2027, 2028. But you're already starting to see some of the earlier markets starting to come back already. With again, they are predicting 2026, mid 2026 out there for this start to happen. And this is all stuff that we know now, right? The data on this is very readily available through CoStar, Yardi, RealPage, great resources. So yeah, rent growth is expected to rebound in 2024 with a 1% increase across major markets, which is a little bit lower than normal. Normal, you want to keep up with pace of inflation 2 to 3%. So rents are growing, but I would say because of the new supply, you're seeing that sluggish. But like I said it before, we should see us turn the corner, I would say sometime next year. new apartment construction is down 25% from last year, which should lead to higher occupancy rates and rent growth in the near term future. And again, my hunch on near term, maybe the end of 2025 into 2026. And this is just another couple of resources here. This is from CoStar, October 2024. Basically, the story is the light at the end of the tunnel, the delivery falling off in 2025. And then as these apartments come online, the 2023, 2024 peaks of new building babies being born, you're seeing them get absorbed, right? This is the game of supply and demand. New supply, a heck of a lot more supply than normal, getting put into the dating pool, if you want to call it that way. Since we're talking babies here, it gets thrown in there, but which of them are finding mates, or in this case, finding a tenant? And that's what is called absorption in the industry. So you're seeing these units are getting absorbed, right? Which speaks to partially some of these numbers that we don't know, which is the demand. If absorption falls down, then we know the demand is not there. But absorption is showing that it is strong. Again, to recap, focus on newer, more institutional assets. Again, this is a weakness for the next 1 to a couple years. That weakness is going to be more on the lower end Class C and B properties. And it's something that I think we've maybe outgrew ourselves. Like I think with Class B and C assets, that's where we got our start. We had some good exits on those, but it is difficult because the tenants are real difficult. One of them, we made great money, but the thing never got more than 80% of people on collections, meaning that 1 out of 5 people were just deadbeats and never paid us, yet we still did well. But also when you're dealing with like crappy 1960s, 1980 property, no matter how much due diligence or third-party inspectors you get, things are just going to break. It's like getting mad at your mechanic for why your 96 Honda Civic XYZ broke. It's just going to happen. That's just how it happens. Still focusing on the Sun Belt due to the long-term job growth and population growth. Those are the market fundamentals. Although I think the next couple of years, you're going to see this new supply hit the market, then back off. That's all short-term stuff, right? And I think that's what we want to keep aligned more in the long term, the vision on the horizon, the long term. And then when you combo that with long-term debt, 5, 10-year or 8-year terms, assuming the numbers work, it provides a strategy where you can stay in the game, do value add, and more than likely, assuming that the market comes back, you look like a genius. But if not, I will be happy to invest in a flat market. I do think that inflation is going to come back. So if that's the case, buy assets, buy things that go up with the pace of inflation. I think with that, I don't give any financial advice. That's all your guys' job. And you guys, but if you're sitting in a money market account because you think you're clever for getting these higher rates, it's coming down, but that's the stuff that is going to get killed by inflation. 2024, to substantiate some of these numbers, was a supply high of 650,000 new units, a 40-year record. And again, that's all at the tail end of those interest rates, 2022. And remember, the interest rates started to go up, and boy, did they go up really quickly in the summer of 2022. I remember because I was drinking wine in Napa in the end of that year, and we had just refinanced one of our developments to a long-term permanent financing, and the interest rates were just moving so quickly. And I just thought to myself, whoa, we really got lucky because it was getting really bad once you got into 2023 in terms of interest rates. And that was at a point where developments, if you were smart, you put it on hold, you put it on ice. But also from a demand standpoint, 2024 net absorption surpassed that of 2023. And we talked about some of the dynamics between A, B, and C properties. That's temporary. I think that's a trend that's going to happen. I'm not saying that they never want to buy Class B and C assets, but right now I think the A's make a little bit more sense, 20-year or less. Again, to remind people of the long-term trends, the fundamentals, the things that are 10 years more longer term. As of earlier this year, renting is $825 cheaper per month on average than buying a home. We are becoming a nation of renters. That's why the dynamics and population is going up in America, especially in the lower middle class and these specific submarkets. Another couple miscellaneous trends to watch: natural disaster impacts. I was just talking to some investors about skyrocketing insurance costs. It's something that we've seen even as early as 2020. I think everything that we see happen comes out to you guys like 3-4 years later. Individual homeowners insurance, condos insurance. This is old news to us. I remember our apartment in Mississippi, like our insurance tripled on that one. This is maybe, yeah, around the pandemic or even before the pandemic. As I understand it, or what the insurance companies tell me or brokers, is right now where insurance costs go up and down, it's cyclical. Of course, just like inflation, it never goes back down, right? Things always get more expensive. But there's somewhat of a curve, a flow that's ever pacing upwards. And right now we're at this peaking moment. Part of that is caused by a lot of these reserves are being drained by just a lot of unlucky supernatural disaster events. Hurricane Helen, good example of that. And then especially hitting certain sectors, like we don't want to invest south of Birmingham, Alabama, for example. Work done in the lower Harris County, Houston, for example. That is more because of the taxes too. But if you get on the southern part of Houston, and if you're not a local and you don't know where the 100-year floodplains are and the real floodplains are, your insurance are going to skyrocket. Florida is a lot higher insurance out there too. But the closer you are to that Gulf southern part, the worse it's going to be. Jacksonville is on the other side, a little bit less of a insurance increase factor there. But I think that's something to take note of. What you're seeing a lot of operators do is they'll buy these more portfolio insurance policies. It covers all their assets, and then they just appropriately divvy out the costs. There's some issues and risks to that. I think the way that where our heads are at, it makes more sense just having more coverage and being able to sleep at night, that a policy per asset. But those are just some of the things that people are doing out there to cut some corners and make things work, right? Because taxes and insurance have skyrocketed, and that's not in the control of anybody. You can't not have insurance. The mortgage companies, the banks, they require insurance. Office vacancies remain high, with net absorption and many other properties viewed as distressed. The issue is like long term. And I come back to, okay, what's going to happen 10 years from now? People still going to be using apartments, need a place to live. Depending on what area, I'm pretty bullish, right? I think that's everybody needs to come up with their investment thesis. We had some big changes with how people work from home through the pandemic. And maybe call me a little old school, but what I talk a lot in my business boardrooms, where a lot of us business owners talk and CEOs talk, is it really is difficult for people from a social and collaboration point of view to get things done and come up with creative ideas when everybody's working from home and there's so many distractions. And yeah, I get it. It's good quality of life. Nobody wants to be stuck in traffic, but I think this is why you're seeing creative companies like Apple telling everybody needs to get their butts back into the office so they can actually mastermind things together. Maybe that's just a sign I'm getting old. But either way, I think it's up in the air whether office is going to be as needed as it once was. But what we do know now that you're seeing a lot of distress in that sector. And you're seeing some banks right now, they're heavily underneath where the asset is worth. And even the banks are wondering, what the heck do they do with this? You can repurpose an asset. That takes a lot of money to do. But when people talk about commercial real estate, mind you, they're talking about office, self-storage, apartments, even manufactured housing, all kinds of real estate in there is what's considered commercial. All right, so let's talk about the election. So here's what Trump said. Trump has often criticized the Fed's independence, suggesting it limits its economic growth. So he is obviously going to put pressure on the Fed. Who knows what's real these days, right? Supposedly, some people say that he has like a personal vendetta against Powell, and Trump owns a lot of real estate. So it behooves him to push the interest rates down. But even for my economy, right? You push interest rates down, the wheels start moving in the economy. I'm not going to pontificate if that's good in the long term. What we're trying to do here is just dictate on what is going to happen in the near term. This is, I think, where we do get a little bit more near term, meaning what's going on the next 2 to 4 years. We're recording this the end of 2024. We know Trump's going to be in there, but we don't know what the heck he's going to do in terms of economic policy. We know what he said, and that's what we're talking about here, but he was just trying to win the election. Like, and that's where we're going to be doing a webinar. Have the CPAs coming on in January. We're trying to hammer down a date to bring them on and analyze some of the early indications on what actually the policies are going to be. So if you're not on the newsletter, I would say get on it. It usually comes out every Tuesday. You can get that at thewealthelevator.com/club. But I think if you're thinking Trump's going to get his way, he's going to lower these interest rates a little quicker than what was originally expected. A little bit less emphasis on inflation control because he generally prioritized growth and employment over inflation concern, which we've seen this develop. The tax bill got signed, bonus depreciation came back. He's obviously pressuring Powell, but Powell has a good reason why he's not dropping rates because he's like, damn it, man, your tariffs are killing me, man, with inflation. So we've kind of seen this all play out. Nothing's out of surprise here from last 6 months. Okay, back to it. Why this might be a good thing for investors. So economic coordination just could increase the efficiency for aligning fiscal and monetary policies. I think he generally has this idea where he wants to remove barriers, less government regulation. When you remove those barriers, you would think that money and business flow a little bit more streamlined. Now, potential risks, I'm not going to say it's all good. I think it's generally better for investors, but I'm going to watch my tongue here. I don't want to offend anybody, or everybody's got so many opinions these days. Just relax, guys, and just trying to call it how it is. I don't know if it's good in the long term, but I take the stance where, all right, as an investor, actually, I will take the stance. I am a libertarian by nature. I just want to know where the puck is going, and I'm going to skate to the puck. I'm not going to say whether one is right or what should be done. I'm going to shut up and do what's best for myself and my family. And I don't care what you do with your body. I respect everybody. I want to be inclusive to people, but maybe it sounds selfish, but hey guys, it's just money, right? At this point, I think that's what the definition of a libertarian is. But so I try, hopefully you guys, when you guys listen to some of my talks, if I come across as one side or the other, I'm really not. I'm just trying to read the situation and trying to position myself the best way. Trump's talks of putting in more tariffs, and this is something I don't completely understand myself. Like, how does that impact economically in America? You would think that is going to increase demand for U.S. labor and production because now we're maybe buying things less outside of the country. I don't know the other repercussions of that. I know he's also big on oil and gas and crypto. So I know a lot of people in our community, they love those oil and gas deals for the tax benefits. I would always be careful, guys. Like, I haven't really found a good operator. I'm an investor in this oil and gas deal, and I guess they want to put me in another fund. I don't know what the heck is going on, but I've been barely getting since I started. I got the IDCs, the tax credits essentially, but I think that's the hard thing with these oil and gas deals. You're literally drilling a hole in the ground, and yeah, you get some tax benefits from it, but at the end of the day, maybe call me old school, but I just want to invest in a piece of real estate or a business that's performing, and maybe I get a little lucky with some market appreciation. But yeah, as far as I mentioned earlier, less government regulation should bode well for the crypto fans out there. Deregulation on that. Again, I don't know the repercussions of that type of stuff long term. As we've seen, there's some failures here on Turkey, Argentina, Venezuela, Zimbabwe suffered severe economic instability with inflation, but obviously better than those countries, especially because we have the best military, we control monetary policy. and then other successes of this type of economic path in the future, like the US World War II. It seems like the wars helped things out. Israel in 1985, the UK in the 1930s, and this achieved stability with targeted temporary interventions. What we do know, I'll give a little bit update on some of those discussions. So Trump had his little party for his Trump coin. That was kind of a big thing that happened the last few months ago. I actually knew some people who had those coins and were able to go and attend. They said it was kind of cool. We've seen some companies adopt Bitcoin as their reserve currency or keep reserves in there. But yeah, I think we've seen some escalations in some military. Iran, apparently we blew up their reserves of uranium or whatnot. I was a little worried that Iran would retaliate on Independence Day 2025. I don't think anything happened. What else did I mention 6 months ago? We still don't know. So like the tax stuff went through, but what we always wait for is like the interpretation from the CPAs on actually how to do this. And usually you find like one or two cool ways to tweak it to help us in particular. So when we find that out, I will pass that on for sure. And there's about 10 minutes left, I think, in this thing. Is commercial real estate is down, and there are signs that have come back up, maybe as far as 6 months ago and coming back. Interest rates are coming down. But I think there's a tale of two tales here, right? You have deals that were purchased at the peak. You can't do anything to change that. And why did the prices come down? In commercial real estate, you have the market price, and that's dictated by the net operating income, or those of you guys who are familiar with EBITDA, basically your income minus your expenses. Think of it like that, divided by your prevailing cap rate in the market. And this is why the exit cap rate in that syndication e-course is so important. And you're going to see this play out. So here on the right side, maybe you buy a property for $100 million that had a $4 million net operating income. And the market, prevailing cap rate in the market, meaning you ask the broker, hey, this Class C property in this soft part of Fort Worth, what's the cap rate? And they'll say a number like 6, right? In this case, it was 4. So that's the magic formula to get the market price. But what happened is you saw the cap rates, because the interest rates, as we mentioned earlier, totally go haywire, and it increased. And again, this is what confuses a lot of people when they're new to this. When the prevailing cap rate increases, you're seeing the market price drastically decrease. So same asset. Heck, you could even have an asset that's making even more money. But because that the impact of that denominator is so strong, the market value plummeted. And this is essentially what happened the last couple of years. Now, what if somebody was like, all right, we're going to increase the business plan. We're going to do it all in one day, renovate all the units and increase the NOI from 4 million to 4.8 million. But if you're still selling it in that same crappy 6 cap rate market, your property's still way less than what you bought it for. And this is the situation that you're seeing pretty much all assets out there. Maybe your loan is good, but your market value is pretty much what it was in 2020. It's like you went on a nap and came back. But what this means is properties with the established basis, or what the heck they bought that thing for, you can't shake that. You bought it for 100 million and now it's worth 80. And you may be forced to sell now, or you may be able to hold it, but you're going to have to wait for that thing to come back to 100 million, which may take several years for that to happen. For those properties purchased between 2020 to 2023, you're screwed. That's the basis. You can't change that. Now, this is where it's very unfair for new investors entering new deals today with the prices of today, the after, buying this thing at 67 million, same NOI at the higher prevailing cap rate today, which is not controlled by anybody. It's controlled by interest rates and 30% other things, as we said earlier. You're buying it at this price, and that's your basis. That's your entry point. So if the cap rates return to what it was at 0.04, you just made 30 something million dollars right here for not doing anything. Now, this is a huge jump, right? And what we've seen happen transpired is a huge correction, bigger than 2008 in commercial real estate. Now, I don't think it's reasonable to expect a 2% cap rate change to reverse back to where it was. I think it may take at least several years to get there at the very least, but maybe it comes down to a fraction of that. Still, the trade winds are at your back, but more importantly, I'm getting back to this and I want to hammer home or push this point home. The basis today that you bought the asset is low. Not saying that it could go lower, but it's low. So we can't tell the future, but CBRE, this is their projections on what's going to happen in the future. So you're seeing the 10-year treasury there, the bars, and I got the Champion Financial curve coming up for those of you guys who like to place bets with your friends where interest rates are going to be. CBR is predicting that interest rates in the threes in a couple of years, and then maybe settle somewhere in the 3 long term. But I can guarantee something is going to happen that's going to change this. A war, pandemic. We know there's uncertainty in life. You're seeing the cap rates. And if you're just focusing on multifamily one here, and of course, this is industry wide, the data is going to be bringing in all markets, all asset classes, but just relatively speaking, they're pointing to right now as the peak of the prevailing cap rates, which since we know from the last slide, that's bad, right? That means your property is worth less. But we're seeing that come down. They're saying like, if I read it from this notch to this notch, that's a half a point correction or compression in 3 years, maybe a little bit more than a full point in 6 years. I'm hoping it's going to be a little bit more aggressive cap rate compression, but I think this is a good guess because nobody knows. Nobody knows. And a little reminder earlier in the presentation, I gave kind of the range of 0.1% every year on the conservative side to 0.2% every year on the more aggressive side as a couple other data points thrown in there too. And of course, that's more of a long tail future forward-looking projection, but that's the best estimates that anybody has. Here's the Chatham financial curve, and this other one, this is the more current one, but I just wanted to show where we were looking in mid-2024. These predictions change, but at this point, they were calling the near-term low January 2026, and I don't think that they called for a half a point drop right away, but you're seeing, this is the more mature, the latest and greatest. This changes by the minute. But you're seeing us at 3.68 come this time in 2025. So what this means, if you're seeing like a full point coming down, so maybe a quarter point every few months is the trend line. Of course, this doesn't really impact like the 10-year treasury 1-for-1 or what mortgage rates are, but this is where the beginning of where the Fed dictates the rates and everything's extrapolated from there. Let me do a quick update for mid-2025. Now this is kind of elongated out and now the Fed now predicts future rate cuts late 2026 instead of early 2026 with a higher likelihood of higher for longer. So that's the tagline, right? Like when commercial real estate hit the crapper a few years ago, everybody had the saying, survive to 2025. Well, 2025 here and the recovery isn't really happened yet. So now that saying is kind of turned into higher for longer in terms of interest rates. And that's where this is just all taking a lot longer. That's why I've kind of given you a more lazy rendition of this semi-annual market report, because this is all has just taken a lot longer and it's moving a lot slower than what everybody is thinking. But I think the one huge thing that I'll highlight is that we all know where the pieces are falling. We know what supply demand is happening. We know generally what's happening with interest rates. We know generally that the economy is good. We just got to get over this tariffs thing right now. And this is one of those rare opportunities where you know where the pieces are falling before all your amateurs are jumping in and pushing things up. Of our 2024 walkthrough, a lot of good things. If you're reading between the lines here, we don't know what's going to happen in the future. one could assume that interest rates are on the decline as they have been, barring a black swan event, which you never know can happen. I can't really think of too many when you take a SWOT analysis, strengths, weaknesses, opportunity, trends. I see a lot of more strengths. And if you guys are interested in seeing more of a detailed report, you guys can email our team and we can get you access to some of those if you'd like to geek out on that. 2025, 2026 from an economic perspective is lighting up green. It says ITR economics. Of course, still you want to buy best of class assets and best of class businesses in the private equity side that we're doing now. But I think that the trade winds do appear to be on our back, but it comes at a time where, and it's an emotional thing too, for those people who were in the market in 2021 or just entered the market in 2020, that was probably the worst time to start. It's tough emotionally to re-enter the market when you've had struggles, which makes a lot of sense, right? Like when deals are the best, when liquidity is at its less. My goodness, I didn't intend to say that Dr. Seuss rhyme thing, but that makes a lot of sense. And also in 2021, when rents were skyrocketing, inflation was high, asset values were going through the huge gains. It was also a time where investors on the investor level were just going into deals and it was rolling. And yeah, I said we were going to do it for 5 years. It took 2.5. And we just wrote, people had money in their wallets and just rolling. And right now we are at the complete 180 of that. So it's one of those things. You either have like deals or dollars, one or the other. You're very rarely in equilibrium. Just like you have busy at work and quality of life, you're never going to be really balanced. You're always going to be imbalanced at some point. But I think it takes a couple of market cycles for people to realize that when things are fearful and scared, that's the time to enter the market. That's what the big players, KKR, has done. I recognize these things myself, but I think the way I take a look at it is I'm not going to call a bottom. I'm just going to just dollar cost average is my approach on this and re-diversify the portfolio. It is the way I look at it. But I think the big thing is if you guys haven't yet interacted with our group in person, I would highly suggest coming to the January retreat and meeting other investors. The big missing part of this, as I talk about in my book, The Wealth Elevators, there's different paradigms to this wealth building journey. So it's hard to tell where the heck people are unless you get to know each other in person, you break some bread with them, have some beers, and then you can get a little bit better idea on where they're at. What's your net worth is what I'm getting to. And then at that point, what is your asset allocation mix? I've never been one to say you need to have this much. I think in our world, there is no normal, and people in our world need to understand that. But the hard part is like seeing what some of your peers are doing, not the peers who have 90% traditional investments and 10% life insurance, right? What are the people who have more than 30, 40% alternate investments are doing? What is their asset allocation mix looking like? I haven't really figured out what the heck that is. I think it changes over time as you start to accumulate. I was productive while y'all were watching that. I changed the baby's diaper and I also amended this image here, bonus depreciation. It was set to phase down post 2025, but crisis averted. We're back up to 100%. And I also put in where the Elon Musk, Donald Trump romance started around July 2024 and ended recently here in May or June 2025. And you're probably wondering where all the money came from to fund some of these. Bonus depreciation is going to cut down on government revenue. This is kind of breaks down where the funding came from in relative to each other. And as I mentioned earlier, like some of these things I feel like don't really move the needle. Obviously, Medicaid, SNAP, Spectrum, that's a big chunk, looks like here of it. So maybe I was wrong with that. But overtime and tips, that's barely anything in terms of as a percentage of it all. But with that, any questions from anybody here on any of this stuff? That was a little bit different format this time. But again, a lot of this has kept on longer than anybody thought. But I think that is Let me go down my notes one last time. But yeah, for that, I will close out today's mid 2025. Like I said, we are coming off the bottom here. We have seen some appraisals come back as significantly higher than what it was a year ago. So that's a good sign. I want to just record this quick video to go over the early results of the 2025 survey. I'm recording this summertime of 2025. Well, first off, thanks for completing your survey, unlocking this data, and gives you a little bit more insights on how your little community peers are also voting. But here we go. So the first question was basically, hey, are you interested in private credit, private money lending, senior debt opportunities? Seems most people are pretty interested in that. I think what we're noticing, especially in comparison to some of the other asset classes, is that we have a little bit of a bigger sliver of maybe confusions here, 20%. So if this is you, please reach out. Let us know when you want to schedule time to discuss this very important asset class that has a very strong footholding in most high net worth investors' portfolio. Next one, this is the bread and butter where we came from, right? Interested in equity investments. This also includes the multifamily value add and also ground up developments. A catch-all here seems resounding. Almost 90% of people are interested in that. Maybe some people here maybe didn't understand the question, but if this was you, please reach out as soon as possible. Next asset class was investing in private equity. Now that we're starting to see that interest rates are probably going to be elevated higher for longer, makes sense to go after buying existing businesses. But of course, where we know the operator, and it's the operator that really is the driver of these types of assets, as opposed to where real estate, I think, is more asset driven, right? To use the analogy of the jockey and the horse, in real estate, they typically say the horse is the thing that drives the investment, whereas in private equity, angel investments, it's the jockey or the operator. So as you're starting to see this sliver of people saying no is getting a little bit bigger, I think this is a little bit more exotic to people in our community. I was opposed to it 4 or 5 years ago, but it's definitely changed my mind, and definitely not going to be your entire portfolio. But I've seen a lot of my investing peers that I've grown and matured through the years have this be a big part of their portfolio. I've always said I try to learn and emulate what people who are smarter than I am do. Next one here is early stage angel investments. Seems like a lot of people are just turned off about it. Some people are interested, right? These are investments that do not have any revenue today and are a pipe dream for the future. Next one here is, do we have any business owners out there? And looks like about maybe 75% of you don't fit in the category, but we have a quarter of you guys who either own your own businesses or maybe have a connection with somebody with the business revenue between 1 million to 20 million, who we'd like to have a conversation. We found a lot of great private equity opportunities from people that I've personally joined different entrepreneur mastermind groups with and found some of the last projects to do with. And some of our past investors who we've built relationships have joined in some of our projects with, be good synergies for future deal flow. Lastly here, credit investor banking is a great way, especially the way that we use it, where we use it to charge up your investing account and going out there and making money in 2 places. So if you haven't started implementing this and your net worth is at least $1 million, you need to get on the phone and connect with us or send an email to bank@thewealthelevator.com. But that's it. That's the survey results for now. Maybe when we get maybe a dozen more folks to complete the survey. I know how some of you guys are with surveys. I'm probably guilty of it myself. I don't do surveys, admittedly, but maybe might see some of the data change. But I think we've got a pretty good steady state with now, getting over 40 responses, which is, I think, pretty good here. And lastly, if you have been investing with us in the past and you're not in our family office Ohana Mastermind, let me know. Might be a good situation for you to now get involved. I've always said that if you're looking to invest in maybe 1 or 2 deals, maybe not worth it for you. But certainly when you start to invest more than $250,000 or more than a handful of deals, it starts to make a lot of sense. Because just speaking from my own experience, when I started this in maybe 2016, my first 15 deals I went in, there were a few of them that I were like, maybe I shouldn't have vested with those people. But then again, back then, different time of access to different type of operators, right? These days, if you look at this next deal that we're going to be getting into, third generation family office, right? We wouldn't have access to these types of guys in the future. And while I let that cat out of the bag, we do have some very exciting, very limited opportunities coming up this next quarter. If you haven't engaged with our CIO team, please reach out, team@thewealthelevator.com, and we'll get you scheduled as soon as possible.